This is Conversations, a weekly financial podcast featuring interviews with leading investment strategists, noted technical analysts, and other key thought leaders. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA Podcast Series, and today's guest is Wayne Gorman. According to Gorman, analysis is a mastery of observation, while successful trading is a mastery of self. Wayne Gorman heads Elliott Wave International's education resources. He has taught thousands of people how to forecast and trade with Elliott Wave analysis through seminars and online courses. With more than 30 years of experience as a risk manager and trader, Gorman began his career at Citibank, where he managed trading positions in money market and derivatives, and also worked at Westpac Banking Corp. He traded full-time with his own capital for more than 4 years before joining Elliott Wave International. Welcome to the program, Wayne.
Thank you. I'm very glad to be here.
So let's start at the beginning. How did you become interested in the markets?
Well, my first job was with Citibank, and in my second year at Citibank, I had the opportunity to join the Euro currency desk, which traded various currencies both in the FX market and money markets. This was back in the mid-'70s, so there was no euro back then, so we were trading a lot of different European and Asian currencies. And I loved it. I loved the excitement of it, the interaction with the people that I had to deal with, and the action in the market. And it's to sum it all up, there was nothing more gratifying than being able to make a prediction in the market and have it come true. It's quite a high or euphoric feeling to do that.
Now, you have a new book out called The Visual Guide to Elliott Wave Trading, with you and Jeff Kennedy, also of Elliott Wave fame. And you say, if you can't fit your strategy on a 3x5 card, it's probably too complicated. And most of our listeners are at least familiar with the CMT program, where Bob Prechter's Elliott Wave book is required reading. So if the strategy should fit on a 3x5 card, is Prechter's book too long?
Yeah, that's a great question. Yeah, it's really apples and oranges here. The Frost and Prechter book, Elliott Wave Principle, is a comprehensive and in-depth description of the Elliott Wave pattern. It does not address how you apply that pattern in trading or investing situations. It's purely a description of all the characteristics of the pattern. Once it comes down to then executing your trading strategy based on that pattern, that strategy itself, your entry point, your protective stop, your price target, that should not be a very long, complicated essay. You should be able to articulate that in very few words on a small piece of paper, actually. What takes a long time is trying to describe all the different patterns and all of their characteristics and tendencies and so on. So, and that was one of the reasons for doing the Visual Guide to Elliott Wave Trading, was to bridge the gap between theory and application. Like I said, the Frost and Prechter book does not get into the application really at all. It's implicit as to what you might do, but it doesn't explicitly explain, okay, given that this is the pattern, how do I do a trade with this information? So they are two totally different things.
Now, your career in the market started before the Elliott Wave Principle was even written, so I'm assuming you have other tools in your toolbox besides Elliott Wave. What are some of your tools that you use, or is it exclusively Elliott Wave now? Yeah,
it is pretty much just Elliott Wave now, combined with, I'll look at sentiment indicators and momentum indicators, but I wouldn't rely too much on them. My core tool is the Elliott Wave pattern, because when I first started trading in the 70s, of course I was just relying on economic fundamentals, and the Elliott Wave International, the company, just started in 1978. It wasn't until about 1985 that I started to learn about Elliott Wave, and after gaining confidence in that, I started to use it with real money around 1986, because of course by then the Frost and Prechter book was out. But yeah, I like Elliott Wave as opposed to other forms of technical analysis because it's so scientifically based. I mean, it's really rooted in what drives human nature, the social sciences like sociology and psychology. It just seems to have that foundation. It's not just a gimmick or some kind of formula or a black box. It really relates back to human nature, human emotions. So I use it as my main tool, and try not to be influenced by the news and economic fundamentals.
Sure. Well, let's talk about the actual trading. In the book, you talk about the anatomy of a successful trade. And in the book, you say that trade management or risk management is about 30% of a trade, and actual trade technique is only 10% of a trade, and the other 60% is psychology. Can you talk to me about the anatomy of a trade? It was kind of a surprising breakdown to me to see it that way, that trade technique was so low and psychology was so high.
Yeah, I'll explain that. Let's first, I'll leave the psychology part for last. And let me just say, in terms of the risk management part, well, that gets into where do you set your protective stop, what's your price target, where are you going to enter, and you can use Elliott Wave to determine all of those variables. And then as the price action proceeds, let's say, assuming it goes in your direction, then you're getting into, well, where do I move my stop? What's a logical place? Because you want to allow yourself certain freedom to carry the position and make it as profitable as possible. So it's important to constantly monitor, keep adjusting your stop, and then at some point, if you're in profit, you would want to make sure that you lock that profit in. That, you know, the standard saying on trading desks is never let a profit turn into a loss. So these are all various aspects of risk management. The size of your position, you certainly don't want to risk more than what you have capital available, and so on. And that's what we mean by risk management. And Elliott Wave provides you with the intelligence and information to set all of those variables. Technique, what we mean by technique, well, that gets into when you enter a position, you can do it manually. You could use Elliott Wave, and that could show you, okay, according to Elliott Wave, maybe if the market breaks a certain channel or trend line, you're going to get in, and you could just do that manually, meaning you'll just make that decision when it happens. But a good technique would be to put in a market order. In other words, don't wait for the move to break what you're looking for, to break that threshold. You should have a stop order in, like you're going long at X price on a stop. And it's better many times to enter positions that way. In the sense, put it on automatic pilot. Don't try to do it manually, because you might miss a lot of the move. You may scale in and scale out. In other words, you might not do your full amount at first. You might do the small pieces and get out in small pieces. And then OCO orders, one cancels the other. Once you're in profit, you would, what I often do is I'll set a profit stop order, market order, and my protective stop will both be in at the same time, and either I'll get stopped out one way or the other, but I've protected myself. These are all various techniques, but they're not, none of the things I've mentioned are as significant as what we call psychology. And what we're referring to by psychology is that you have to be disciplined to do this. You have to be patient. You have to know what your risk tolerance is. Sometimes you feel you may be comfortable with a certain position and then realize you're not comfortable with a potential loss that could occur. And it really comes down to controlling your emotions. And there's somewhat of a paradox here. I'm just going to spend a minute or two talking about it, and that is that what Elliott wave does, and other forms of technical analysis, it really helps you to separate you from the crowd, from that mass psychology, which according to Elliott wave and the underlying science of Elliott wave, which is called socionomics, that people are engaged in crowd behavior and they're kind of swept away by their emotions, and then they rationalize it after the fact. So Elliott wave will extricate you from that crowd behavior so that you can look at the markets objectively and not get all caught up in the emotions, whether they're positive emotions or negative. But you are a human being, and even if you've done that, you still have your own emotions to deal with. How do you separate yourself from your own personal emotions? You can control them to some extent, but it's difficult. You have to practice this discipline. And as a matter of fact, it can be so difficult that the new trend now is to take your trading strategy and your forecasting model and program them so that you don't even get involved at all. The computer does it. And what I mean by that is that not program trading, which is when companies do huge amounts for just one tick. I'm talking about a lot of people now are programming their strategy along with their model, whether it's Elliott wave or not, so that they don't fall into that trap of being subject to their own emotions.
Putting an if-then logic around their strategy.
Oh yeah. I mean, you can put in any logic at all, because no matter how disciplined and patient you are, you still have those emotions. I have them, and you can still fall prey to them. And it, some people don't deal with that as easily as others. So that's why, even with all the analysis and all this, that all looks fine when you're doing it, when you're calm and you're doing it objectively. But in the heat of battle, when you're looking at your screen and you're making these decisions manually because you're not on automatic pilot, sometimes you can do the same thing that the crowd does. You can rationalize away certain emotional responses. Mm-hmm. At a different level. You could say, well, I don't think this way, you're so emotionally want to do something, you could say, well, I don't think this wave is correct anyway, when in fact it was correct, and just rationalize things. So it's, I see more and more now people are getting into programming these things if you have the resources. A lot of people don't have, but certain institutions and companies do have the resources.
Is that taking the easy way out? Is when you say you need to have a mastery of self, is programming the logic of your strategy taking the easy way out, or is that a good way to master yourself?
No, I think that's a good way. That's being honest with yourself. It's not a cop-out. It's being very more honest with looking at yourself in the mirror and saying, wait a minute, I'm not perfect. I have emotions, and I can try to be objective as possible, and I'm going to use Elliott wave, and I'm not going to follow the crowd, and I'm not going to listen to the news and what people are saying or be influenced by events. But how do you? I mean, you're not a robot, and we all have those emotions, and it's not so easy. I mean, as much as I know about Elliott wave, and I've been trading since the late 70s, I still fall prey sometimes. Mm-hmm. I get impatient sometimes, and I'll look at a certain pattern, and I'll say, no, I have to wait till this pattern finishes, and then sometimes I'll say, no, I'm not going to wait. I know I should, but I'm not. Whereas if I had it all programmed in, I wouldn't have that choice.
Right.
I can't change. If it's programmed and you let it go, I can't change my mind. So there is something to be said about creating a model, programming it. Now, will your emotions get into the model itself? Well, okay, there's nothing you can do about it. So, but some people want that control. It's kind of the difference between, flying the plane manually or putting it on automatic pilot. And or a car. And some people want the control. Well, then what we're saying is, fine. But, you got to be disciplined. You got to be patient. You got to know yourself and what risks you're really willing to take. And you have to, you see, we're all brought up to think that the true causality are all these events and things in the news. And it's very hard to shake that off, even if you've been studying Elliott wave, because since we were very young, we were taught that everything is mechanistic when it's not mechanistic. The whole underlying theory of Elliott wave is it's the whole process of causality. It's a holistic model. It's the whole society is a big soupy mix. And it's not what the president does or what the Federal Reserve does or any of these one things. It's this whole social mood that's moving in a certain pattern. But if you've been taught the opposite for many years, you could fall into that old habits, bad habits very easily.
Well, what are you seeing in the market right now? This is being recorded in early mid-December right now. Markets have been selling off for the last few days. What are you seeing from maybe a 30,000-foot view?
Well, again, using Elliott wave and using a number of alternate wave counts, it seems like we are approaching a major top. And we might have already seen that top, but that's possible. But whether or not we've seen it at some point in the near future, meaning over the next, I would say, 3 to 4 months, we should approach a major top and then have a major decline. And what's interesting is that looking at various alternate wave counts, you still come up with that scenario. So that tells me that we definitely will have a severe decline. It may start this month, or it may start next spring. And the differences in these counts is that how severe the decline will be. But it looks like that decline should at the very least come close to the 2009 low, possibly test it. And there's potential even for further decline after that. But at the very least, definitely a nice tradable decline is in the offing. And I'm talking now about the U.S. stock market.
Right. Well, good. Well, Wayne, we're out of time. Is there anything you'd like to add before we go?
Yes, and I think this is something Jeff and I have always talked about and encouraged, and that is that when you're using Elliott wave, it's important that you learn it, that people learn it on their own, that they don't just rely totally on it from what someone else is telling them. Now, of course, we love to have subscribers and so on, and I'm certainly, I don't want to discourage people from subscribing to our products, but they would appreciate our products more if they learned it themselves, and that takes a lot of work and a lot of study, but it's very important to do that and form your own opinion, and then you can compare your opinion to our opinion in our products and publications. That, to me, is the best way to do this, to really understand the pattern, because anyone can make a mistake, and it's a social science. It's not a mathematical formula that you can solve and come to an exact answer.
Well, thank you for your time today, Wayne.
Okay, well, thank you very much for having me.
Today's guest has been Wayne Gorman, and that concludes today's MTA podcast from LexingtonCapitalLLC.com. I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.